Forget everything you know about investing. You have been lied to your whole life. What if your dividend portfolio grew so big you earned more yearly dividend returns than your own primary doctor does salary? I will show you in this guide how to start from scratch, even with zero experience, and out-earn your doctor with dividend stocks alone. Let's talk about building a dividend portfolio. It sounds complicated, but it's really just about owning pieces of good companies that pay you money regularly. This money is called a dividend. Think of it like owning a little apartment building where the tenants pay you rent, except in this case, the companies are your tenants. First, you need to figure out your financial goals. What do you want this portfolio to do for you? Are you saving for retirement, or do you just want some extra income each month? Knowing your goals will help you decide how much risk you can take. You'll also need a budget to see how much you can save regularly. Even small amounts can add up over time thanks to compounding. Next, you'll need a brokerage account. This is like a bank account specifically for investments. There are different types, like a taxable account, a Roth IRA, or a 401k. Roth IRA and 401k accounts can help you save on taxes. Once your account is open, you can start buying dividend stocks, bonds, ETFs, and mutual funds. An ETF is like a basket filled with various stocks. Bonds are like loans you give to companies or the government. It's important to spread your money across different sectors and industries. This is called diversification. Don't put all your eggs in one basket. For example, invest in both technology and healthcare companies. This helps lower your risk if one industry does poorly. Before you buy any stock, do some research. Look at the company's revenue, earnings, and cash flow. See if they have a lot of debt. Also, check their dividend payout ratio. This tells you how much of their earnings they pay out as dividends. A lower payout ratio means the dividend is more secure. The dividend yield is another thing to consider. It tells you how much you'll get back in dividends each year relative to the stock price. Dividend growth is also important. Look for companies that have been raising their dividends consistently over time. Reinvest your dividends automatically. This is called DRIP. This helps you buy even more shares and grow your portfolio faster. There are risks. The stock market can go up and down. Interest rates and inflation can also affect your investments. A company can do poorly, which would also affect your investment. That's why it's so important to diversify and do your research. This is a long-term strategy. Be patient and disciplined. Don't panic when the market goes down. Taxes are another thing to consider. Dividends are taxed differently, depending on whether they are qualified or non-qualified. Tax-advantaged accounts can help you reduce your tax bill. Automate your investments by using dollar-cost averaging. This means investing a fixed amount of money regularly, no matter what the market is doing. Building a dividend portfolio takes time and effort, but it can be a great way to generate passive income and build wealth over the long term. One question that wasn't fully explored here is how different economic cycles, like recessions or periods of high growth, might affect dividend payouts across various sectors. This and other factors, you should definitely research into these further on your own time. If you found this guide helpful, please like, share, and subscribe for more amazing content.